Topic 6. M&A Strategy and Due Diligence. Mergers and acquisitions (M&A) represent one of the most powerful strategic tools available to organizations seeking accelerated growth, competitive advantage, market expansion, technological capability, or business transformation. Unlike organic growth, which often requires significant time and investment, acquisitions enable companies to rapidly acquire new markets, products, technologies, customers, talent, and operational capabilities. However, history demonstrates that many acquisitions fail to achieve expected value due to inadequate strategic alignment, overvaluation, cultural incompatibility, or ineffective integration. Consequently, successful M&A requires a disciplined strategy supported by comprehensive due diligence and strong executive leadership. The Chief Financial Officer, CFO, plays a central role throughout the M&A lifecycle, serving as strategic advisor, financial architect, valuation specialist, risk manager, and integration leader. Rather than focusing solely on transaction execution, the modern CFO evaluates whether an acquisition supports long-term corporate strategy and generates sustainable enterprise value. Every acquisition should strengthen competitive positioning, improve financial performance, enhance strategic capabilities, or create synergies that exceed the cost of investment and integration. The starting point of any successful M&A strategy is strategic rationale. Organizations should pursue acquisitions only when clear strategic objectives exist, such as entering new geographic markets, acquiring innovative technologies, expanding customer segments, strengthening supply chains, increasing operational scale, or accelerating digital transformation. Acquisitions motivated solely by size, market speculation, or short-term earnings growth often fail to create lasting shareholder value. Therefore, strategic fit must precede financial evaluation in every acquisition decision. Enterprise valuation is a critical component of M&A strategy. CFOs assess target companies using multiple valuation methodologies, including discounted cash flow (DCF), comparable company analysis, precedent transaction analysis, and enterprise value multiples, such as EV/EBITDA and EV/revenue. Valuation extends beyond historical financial performance to include expected synergies, growth opportunities, intellectual property, customer relationships, digital assets, market positioning, and organizational capabilities. The objective is to determine intrinsic value while avoiding overpayment that could erode future shareholder returns. Due diligence represents the most comprehensive stage of the acquisition process. It involves systematic investigation of the target organization's financial, operational, legal, tax, commercial, technological, environmental, cybersecurity, and human capital conditions. Financial due diligence verifies earnings quality, cash flows, debt obligations, working capital requirements, accounting policies, and financial projections. Commercial due diligence evaluates competitive positioning, customer concentration, market growth potential, and revenue sustainability. Legal and regulatory due diligence identifies contractual obligations, litigation exposure, intellectual property rights, compliance issues, and regulatory risks that may affect transaction value. Technology and digital due diligence have become increasingly important as organizations invest heavily in digital transformation and artificial intelligence. CFOs now assess enterprise systems, cybersecurity maturity, cloud infrastructure, data governance practices, software assets, automation capabilities, and digital scalability alongside traditional financial analysis. Weak technology architecture or cybersecurity vulnerabilities can significantly reduce acquisition value and create substantial post-transaction integration risks. Human capital and organizational culture have also emerged as critical success factors in modern M&A transactions. Many acquisitions fail because leadership styles, organizational cultures, decision-making processes, and employee expectations cannot be successfully integrated. Due diligence therefore extends beyond financial metrics to include leadership capability, workforce quality, talent retention risks, organizational design, and cultural compatibility. Successful CFOs recognize that people integration is often as important as financial integration in achieving acquisition success. Following transaction completion, integration planning becomes the primary driver of value realization. Synergies expected during acquisition analysis must be translated into measurable operational improvements through integrated systems, organizational restructuring, procurement optimization, technology consolidation, shared services, and revenue enhancement initiatives. CFOs establish financial governance, integration milestones, synergy tracking mechanisms, and performance dashboards that monitor post-merger value creation while minimizing operational disruption. Modern M&A strategy increasingly incorporates environmental, social, and governance (ESG) considerations into acquisition decisions. Investors and regulators expect organizations to evaluate climate risks, governance quality, sustainability practices, supply chain resilience, cybersecurity maturity, diversity initiatives, and social responsibility when assessing acquisition targets. ESG-related liabilities or governance weaknesses can materially affect valuation, financing costs, and long-term shareholder value, making sustainability due diligence an essential component of transaction evaluation. Digital technologies are transforming the M&A process itself. Artificial intelligence, advanced analytics, virtual data rooms, predictive modeling, and machine learning enable finance teams to analyze large volumes of financial and operational information more efficiently while identifying risks and value creation opportunities that traditional analysis may overlook. These technologies improve transaction speed, decision quality, and integration planning while supporting more comprehensive due diligence. Ultimately, M&A strategy and due diligence represent far more than transactional finance activities. They are strategic disciplines that combine corporate strategy, enterprise valuation, capital allocation, risk management, governance, digital transformation, and organizational leadership.